measured. So if there are equity, share-based payments which are, ESOPs which get exchanged, then that the valuation of that will be governed by a separate standard, which is the share-based payment standard, Ind As 102. Will not be governed by the principles of, business combination standard. So examples of potential forms we all aware of, what do you give? You may give a cash, you may give equity instruments, contingent considerations, we'll again cover that, ordinary or preference equity instruments issued, so variety of instruments, cash that may be transferred. An important point to note here, when we say contingent consideration transferred, there could be certain pre-existing relationships. So let's say I'm acquiring a company to which I was also supplying goods. So in the books of that company, there is always a creditor sitting which is payable to me, right? And I'm acquiring that company all over again. So there is already a pre-existing relationship with that company such that I have an asset and a liability, a creditor is sitting in that balance sheet, which is nothing but payable to me. Now I cannot be paying to myself when I acquire I acquire the business. What I am acquiring is the assets and liabilities of those companies. So I cannot be acquiring, the liability which I am going to pay myself. So what do you do in a pre-existing situation? The consideration that you transfer gets allocated. What is towards settling a pre-existing situation and what is towards business? So you have to split that into two parts. So you may have a 10 rupee asset in your books, but now when you fair value the liability that is payable to you, it could be, let's say, 8 rupees. So the difference, that 2 rupees, when you knock off, will be a P&L adjustment, not a part of assets and liabilities transferred in a business combination. So this talks about, So this talks about settlement of a favorable obligation. It could be gain or loss. That will go through a P&L adjustment, not a part of business combination or a goodwill adjustment. Friends, this is again a very, very important aspect which has changed in a business combination. This is the whole, we are all aware of contingent considerations. Anyone? What is a contingent consideration? Any idea?
Which is dependent on happening of certain event.
Dependent on happening of a certain event. So what has happened? You've done a business combination. You tell the acquiree, look, I will pay you 100,000 today. I will pay you another 50,000 after 2 years if the business meets certain turnover, or if you achieve certain profits, I will pay you another 50,000. Okay? That's the 50,000 that you're saying is contingent upon the event happening after 2 years. If it doesn't happen, you don't pay anything, right? So 100,000 is fixed, which you're paying him today for the business. 50,000 is a toss-up. If certain things happen, I'll pay you more. If you pay up, it will be 150, right? So 50,000 is your contingent consideration, which is contingent upon business performances and variety of things. And this is pretty common we see in software acquisitions, where the whole idea is the business needs to perform. In a lot of variety of acquisitions, you have contingent considerations. The important point till date, under Indian GAAP, when you used to do this, we used to wait till the event happened. If we paid 50,000 after 2 years, we would have adjusted. Where would you have parked that? Where would you have adjusted that?
Contingent asset, and then depends upon the virtual certainty whether you are.
So what would be the adjustment? And today, let's say under Indian GAAP, I paid him 100,000 upfront. I paid him this much, right? Now this is contingent. I did not do anything. After 2 years, I have to pay 50,000. So where will I debit this? What accounting caption will? Capital reserve or goodwill? We all clear? Why? Why are we putting it to goodwill? Why do we say it is goodwill? It's a debit to goodwill. But fundamentally, why is it going to goodwill? What are you paying?
Have already been valued.
Absolutely. What you are doing is you are saying this is purchase consideration. The moment you say purchase consideration, the purchase consideration has to be allocated to assets and liabilities. Whatever incremental remains, you're paying because of goodwill. The moment you say contingent consideration, you're not paying him for bonuses or events or something. You're paying him for a business. It is a part of your consideration. So any purchase consideration, now you will, so let's say if I would have said like this, I'm going to pay you 150,000 today, right? We would have allocated 115 to assets, saying liabilities is, let's say, 100,000. The balance 50,000 I would have said is goodwill. Let's me flip this. now I'm saying I'm going to pay you only 100,000. 50,000 I will pay if certain things happen. So today I recorded 100,000, allocated asset liabilities, the difference I recorded, let's say 20,000 goodwill. It's just the way you structured the agreement. At the end of it, the plan is to pay 150,000, either upfront or you defer it. Right? So this is a purchase consideration, hence the adjustment has to be on acquisition accounting assets and liabilities or to goodwill. It cannot be to P&L. That is the current accounting that we follow. Clear? No. Let me just rephrase this. So contingent consideration, what is it? It is a consideration for acquiring business. When you're acquiring a business, it cannot be a P&L debit, right? It has to be allocated to assets and liabilities or to goodwill. Why are you paying him more for the business? If you're paying more, then it is goodwill, right? Because you're paying much more than the asset liabilities, it is goodwill. Because of that, you're paying it. So today in the Indian GAAP, we have been capitalizing to goodwill whenever the consideration is paid. And this is a big difference now, okay? What the guidance requires. And again, what the guidance now requires under Ind As IFRS, that on day one, you make an assessment. Will you be paying this after 2 years? If you believe yes, then you record it at a fair value. Then you record 50,000 and you record your consideration not 100,000, but you say your consideration is 150 and create a liability of 50. Because you're saying I'm going to pay it, it's just that I'm going to pay after 2 years, right? So your liability or the consideration will be at 150 and your goodwill gets, whatever difference will be sitting in goodwill. Now, let's say if you don't end up paying this, you have recorded a liability of payment, right? That you're going to pay a liability of so much of 50,000. You've recorded it on a day one. You don't end up paying it. So what happens? Where will that liability of 50,000 go after 2 years? Business did not achieve its parameters. You have a liability sitting of 50, which you recorded on acquisition. Where will you adjust it? Goodwill? Logically? But you can't do that. It has to go to P&L. So what the guidance is saying, that look, we need to freeze goodwill on day one. You have to make assessments. And don't keep on changing goodwill. Make an assessment. If you believe your purchase consideration is 150, then you record liability of 50 extra and 100. So 150, when you say, you have to pay 150, right? Out of that, 100 I'm paying now, 50 I will pay later. Since I'm going to pay later, I've recorded a liability. So the guidance is saying that once you recorded the acquisition accounting entry on day one, you cannot go on changing that entry. That entry gets freezed. There are certain limited exceptions, and we'll talk about where you can adjust your asset liabilities or goodwill. But other than that, your goodwill gets freezed on day one.
Then I will write off my goodwill more. So
Revalue the goodwill also.
Yeah, so the goodwill anyway has to be tested for impairment, right? But at times, you may still escape impairment because of the level that you test goodwill. You may still not have an impairment, right? Because at a CGU level when you test, you may still not have impairment straight away. It may differ over a period. But the important point here is, if the liability of 50,000 of contingent consideration is not paid, it goes to P&L. Now let's make a situation. You assessed, sorry.
In your example, I take 50,000 as 50,000 or
What is your, no, not discounted, you will make an assessment of what you believe. Let's say you would say 50 will get paid or not.
My question was discount.
No, so you don't. You record at 50,000 to say that this is what I expect to pay. Now the question is, let's say you did not record. You said, I don't think they will achieve the business of 2 years, so I will not record this liability. But you ended up paying after 2 years. Now you don't have a liability in your books, but you are making a payment of 50,000. So where will this payment go now? P&L. Now that's the problem, right? Now this goes to P&L. Your P&L is exposed to volatility. It could be now we need to be very careful because when companies now set up these contingents, so what they may want to do, they may want to just create a liability at a full value of 50,000 on day one. At the end, this could become a hidden reserve because it will flow through your P&L after 2 years. But if you don't record, and if you end up paying, then the straight implication on your P&L is there. This just becomes like an expense. Very judgmental area again. And we need to look at it again. Auditors may want to look at it very closely, some of these situations. When you're setting up contingent consideration, there will be a lot of evidence, or there will be a lot of explanations demanded that why you believe it is paying, what are your forecasts, etc. Because if you set it up and you are expecting not to be paid, then this is like a hidden reserve which just goes to P&L credit after 2 years. A judgmental area, right? That's very important. So if you are going to issue equity instruments, let's say 50,000 I said cash, but I say 50,000 I will issue equity shares. So the question is, equity is not remeasured as you go along 2 years, but a liability. I said I will give you 50,000 cash, a liability. You will constantly keep monitoring it. If at the end of 1 year you believe it is not payable, then immediately you'll have to reverse it. So it is a constant reassessment, remeasured at fair value through P&L in accordance with 109, because it's a liability, an assessment. So you have to keep that assessment going and may have to change to P&L. Any write-ups, write down, go to P&L. The important point is no adjustment to goodwill, okay? Except in a provisional accounting, which we'll talk about. But the whole crux of the standard is don't change goodwill once you record it. Anything residuary plus minus goes to P&L.
Even including the legal cases which is pending from.
Yeah, so that's a very interesting point, and we'll talk about it. So contingent let's say contingent liabilities. And we'll get to that, some of the exceptions. But at this point of time, let's remember that any contingent considerations, okay, will not impact goodwill later on. If it plus or a minus, it will impact P&L. Or if it was equity that was issued, then it goes to equity. If you had equity instruments, that is not a liability, right? Equity instruments, any change you don't revalue. If you don't, you adjust in your reserves. But if you had given a liability to say, I will pay you cash, not equity instruments, and that's a liability, and a liability has to be revalued through P&L.
The only point, Mr. Mirza, when you ask, will it discount? The only thing is, when you record contingent consideration, on the date of acquisition, you record it at the fair value of the consideration. And the fair value aspect would also involve a discounting
So you
element,
record at a
and
40,000.
will also factor in the probability of those contingencies based on
Getting
what
paid.
will come. And based on that, the fair value of the financial liability will get recorded. The way the discounting is going to happen,
When you
but
do a
it is
fair
not
value,
saying
sorry.
present value, you said it recorded the fair value.
Yeah.
Fair value of the liability, and which is similar to how we will normally recognize any financial instruments. So you recognize contingent consideration at fair value. If it is a liability, then you go as per principles of Ind As 32, which we'll discuss with you.
So really, Rajiv, if I was negotiating an acquisition transaction, the contingency element I would measure in such a way that it's equal to what additional value goes into my P&L each year.
Right.
So that if I have to charge it off, it negates the additional gain that I have made or any loss I have made. So I would
Yeah, so the
try and measure it that way.
Yeah.
And earn out. So I would-
The earn-out arrangements, yeah. And there's a fine point to this, and we'll see whether all contingent considerations are treated as acquisition accounting, or they could be, it may not be a form of acquisition accounting. So here we said that, look, I will pay you 50,000 later, and that is, we are saying it's a part of acquisition accounting. Hence, we've recorded that as a liability on acquisition and adjusted goodwill.
That 50 is a percentage linked to the payment.
Sorry, it's not a percentage linked to the payment.
The term is like some percentage linked to the payment. If that 50 is
Yeah, so what we have said in this example that I gave, that after 2 years, and this is pretty common, that you say, look, I'm acquiring your business, but if this business achieves certain turnover after 2 years or achieves certain profit percentage, then I pay 50,000. So this 50,000 is contingent upon the business achieving certain, only then you release.
like each year I am doing a business, I am getting a profit. So basis that profit and basis that percentage, can I create that reserve?
No, it's not, you can't create each year. That's what we are saying. On day one, an assessment has to be made. What is the fair value of this that you're going to pay out? If you believe it is not going to happen based as you go along, then obviously you reverse this to P&L, or adjust to P&L. Now, the important point is, we said goodwill is freezed on acquisition. You cannot change goodwill. Certain exceptions, you get a window of 1 year, measurement period window is called. So for instance, a lot of times this asset valuations don't happen immediately. Let's say you acquired something on February, March is your closure. So practically you cannot finish all your fair valuations, everything within that 1 month or 2 month window. You may need more time. So the guidance recognizes this. So it says for convenience driven, it gives you a 1 year window from the date of acquisition where you can adjust your asset values. So it says, as of the cutoff date, you record on a provisional basis, but as you freeze up the numbers, then you adjust it, but you can do that only within 1 year. So it gives you a 1 year window to adjust your fair values and goodwill, etc. because of convenience. to ensure that you are getting the right numbers. If you are not able to close the acquisition within that time, that's where you get that window, right? Otherwise, that window is not available.
Rajiv, what about a contingent clawback, where I say if the business doesn't achieve certain things,
Correct.
the seller must refund to me
Right.
some of the consideration.
So,
Then what?
yeah, so there is a indemnification asset, we'll get to it, that is called indemnification assets, and we'll get to that, right? But broadly, goodwill is freezed, except for convenience, you get a 1-year window where you can adjust fair values, because it takes time to adjust at times, so you get. So it says that's the only measurement period window you get where you can adjust goodwill, but not for items like contingent considerations, which you have to make an assessment on day 1. Any change, P&L, if it is a liability.
This is also applicable to cases where we only buy out the shares of that company and the company is as it is.
So come again, what is
I
the,
buy out 100% of his
Correct.
shares of the company and I pay him some more.
so you've not, the question is, you've paid him, right? Is there anything more that you're saying I will pay you?
Still, there is a contingent consideration.
Yeah, so if you say that I'll pay you more, if certain parameters are met, that is contingent consideration.
But then will the goodwill situation arise that time? Because then it will be a consideration, goodwill on
No, no, no. So on the date of acquisition, what is required is you make an assessment. How much is the fair value? What is it that is likely to be paid out? If you believe that, let's say 2 lakhs is what I'll have to pay, then you will record a liability on 2 lakhs on the date of acquisition. And that is what we are saying, that liability then has to be fair valued again to say, is it likely to be paid and released to P&L? Okay. Just an example, this will be more on the equity side, but we can go through this. So on Jan, the entity A acquires 100% interest in entity B. The consideration for acquisition is payable in 2 tranches. An immediate issuance of 1 million shares of entity A having face value of 10 per share. Further issuance of 0.2 million shares after 1 year if the profit before interest and tax for the first following years exceed 5 lakhs. So here the contingent consideration is an equity instrument. I am going to give you equity instruments. I am not going to pay you. There is no liability, but I am going to issue equity, right? So you have to be very clear, what is the contingent? Are you going to be paying equity? Are you going to be paying liability? Okay. At the date of acquisition, the fair values of shares were 20 per share. The management has estimated that at the date of acquisition, the fair value of contingent consideration is 2.5 million. At the end of year 1, it is noted that entity A has actually met the condition of issuance of further shares. At that date, the fair value of the shares of the entity A is 25 per share. Now, how should be treated the contingent consideration at initial recognition and subsequently? So what is the fair value of the contingent consideration? 2.5, right? Let's look at this example. At the date of acquisition, consideration payable for acquisition is calculated below. Fair values of shares issued. What have I issued? 100,000. And what was the value on that date? 20. So this is 20 lakhs that I've issued. Now I have to also record a fair value of contingent consideration as a liability or as an equity, right? So this is an equity. I'm going to give a fixed number of shares. So fair value of contingent consideration is 2.5. So what I'm saying is my purchase consideration is 22.5 million. And now this 22.5 million gets allocated to assets, liabilities, and balance remains as goodwill, right? Now regarding number of shares to be issued is stated to be fixed. Again, we'll cover the requirement where it financial instrument where equity shares, when you issue as a fixed number and you know that, then that is called equity. But if it is not, it's a variable number, then it could become liability. And here there's an example, we'll cover that. But here we are saying that we know exactly how many shares I will issue. Hence, it meets a definition of equity. No obligation to pay cash, so there's no liability, but I have to issue equity. Thus, it meets the definition of equity under Ind As 32. Accordingly, 2.5 million would be classified as a part of equity. It will not be again remeasured as you go along. You will stick with 2.5. Only on the date when this, after 1 year, you will evaluate whether you are, this is to be released or not to be released. If not, if the conditions are not met, then you reverse this in equity itself, because today you have recorded this as within equity, not as a liability. Had you recorded a liability, the difference would go to P&L, but within an equity, anything that changes will go to reserves, right? So not to be measured, amount recognized initially would be split into share capital and share premium upon issuance of shares. Now let's tweak this. In the same case, example 2, except the following, the number of shares to be issued is after 1 year is not fixed. Okay, I'm saying, I'm going to give you, rather entity A agreed to issue as many shares as have the fair value of 4 million. So I'm saying I'm going to compensate you for 4 million. That could be by way of cash, that's one way to do it. Or say I will issue equity shares that equal market price of 4 million, right? The moment you say this becomes a liability. Because you are ensuring a specific sum of 4 million is your obligation to compensate him. How you do it is different, is not laid down. So the moment you fix this, I'm going to pay you 4 million, you will record, the earlier when we said it was equity, now this becomes like a liability. So you will record assets taken over, to assets debit, to liabilities credit, and to contingent consideration liability of so and so amount. The management estimate date of acquisition, fair value was 2.5. At the end of year 1, noted that entities actually met the condition. At that date, the fair value was 25 per share. So once you said it is a liability, what do you need to do? Periodically? Revalue, right? Periodically do a fair. What is the state of the liability? Plus minus goes to P&L. So if you look at this, at the date of acquisition, consideration payable for acquisition is 22.5, which is the same what we had earlier. Regarding contingent consideration, the number of shares is varying. It meets the definition of liability. Liability would be fair valued at the end of 1 year and resulting loss. That is, you're going to pay him 4 million. You recorded 2.5 on day 1 as contingent consideration. But you're going to pay 4 million as you go along, right? So 4 million is the liability. The difference will go to P&L. Subsequent to restatement of liability, entity A would recognize issuance of so and so shares. So you have to issue shares equivalent to 4 million, which is what you're doing. You're going to say 4 million I have to compensate. At the end of year 1, what is the price of the shares? 25. So 4 lakhs, 4 million divided by 25, I will issue so many number of shares, right? The difference in this example was, we said 2.5 we freezed on day 1 as contingent consideration. In the first case, we did not revalue as we go along. But when you do 4 million now, because you know now how to compensate for 4 million, that is the amount he has to take away. You're going to issue equivalent shares. Hence, 2.5 minus 4, the difference is going to P&L. Now, had I, forget all these equity shares, I would have just said, I'm going to pay you 4 million, right? I'm going to release 4 million to you. The probability or the fair value assessment was that 2.5 is what is the fair value on day 1. So I recorded 2.5. I have to true up that as I go along. Actually, now I'm going to pay 4 million. So the difference is nothing but a difference in P&L. A revaluation of a liability always goes to P&L, right? Hence, important to note, in this situation, is it equity or liability that you're issuing? The moment you say fixed number of shares, I will issue 10,000 shares, it will get to equity. You will not revalue again. But the moment you say, I will compensate you to the extent of 4 million, then that's a problem. You're getting into a liability territory, difference goes to P&L.
Rajiv, the seller's accounting will not at all be like this.
Seller is nothing. For him, he's just selling off the assets. All this is in the...
Contingent receivable for him.
He doesn't record a contingent receivable because you don't record contingent assets. Again, a very fine point here that we need to be careful about. Having just understood what is contingent consideration, we said it's an adjustment to purchase price, hence difference goes to goodwill. A very fine point which we need to evaluate. What is this contingent consideration? Is it like a bonus payment that I'm going to make? So I'm saying if you continue in business, I will pay you 20 million. So this is linked to performance of the person. It is like a payroll payment. So hence it will not meet the definition of a purchase consideration. It will have to be taken straight to P&L. And that's a biggest difference and a very practical issue we see at times. So how do you distinguish a contingent consideration as linked to purchase consideration, or is it in the form of a payroll or a compensation to the employee? Because you normally say the promoter, you want him to continue, right? Because he has the knowledge. You say, look, if you continue in business, I will pay you 2 million after 1 year. So what are the fine points we need to look in the agreements?
One basic question, when we are talking about consideration, so like in case of share, so we have to consider fair value of share or book value?
Fair value of shares on the date of acquisition. That is your purchase, because see, that is the amount he's gaining, right? So if he had to sell those shares in the market, that is what he will get. That is the amount that he will get. So that's the consideration on the date of acquisition. So moving back here, some very fine points that we need to look at an agreement very carefully in acquisition accounting. When is it considered to be a remuneration? When do you say this contingent consideration is not linked to business? It is actually remuneration that you're paying, and hence outside business combination needs to go straight to P&L. It coincides with or exceeds the payment period. Not reasonable. So it says that if you leave business, you don't get this. Then you're clearly saying that this is nothing but an incentive for him to continuing business. You want the promoter of the company that you acquired to continue in that business. Only then the business generates. So you're giving him an extra incentive on his own account. Coincides with or exceeds payment period. Not reasonable compared to other employees. You're giving him something much more. So indicators and when it is a contingent considerations, shorter than payment periods, it could be much more than the shorter than the payment periods. Duration of the required employment, so reasonable compared to other employees versus is it unreasonable? So are you distinguishing payments of contingent consideration to various people? May need to look at it. Other non-employees selling shareholders receive lower additional payments, own substantially all shares. Formula for payment is not linked to valuation. It is not linked to valuation of the business. It is more of bonus incentive for the person to continue based on performance of that person. So then this becomes a problem, and we've seen practically, you need to read the agreement very carefully. The moment in the agreement it is said that the contingent consideration will be paid only if you continue in employment. It is not paid to you if you leave employment. Then this is nothing but an incentive for him to continue. It's a payroll. It's a compensation for him to continue. It is not linked to business valuation. You're not linking it to business. You're not saying the value of the business is 150. You're saying the value of the business is 100, but 50 I'm going to pay you bonuses for you to consider, for you to continue in employment. Hence then the purchase consideration is only 100,000. The 50,000 that you pay will not be a goodwill adjustment. It is straight P&L. It is like paying salaries to the person. Okay, very, very important, and again very practical. You'll have to see the agreements, and you'll see this standing a lot of scrutiny, and we've seen this. At times we enter into agreements and it is mentioned there clearly. It is linked to continuation of employments. I am going to pay the promoter if he continues to employment. The moment you say that, there's a problem. This is not a business valuation or a purchase consideration. It is payroll. It's compensation. Hence, we need to be very clear when we read these agreements or draft agreements. Had we said that, even if you leave or not leave, you will still get the money after 3 years. And that's a different thing. That's a business. You valued the business at 50,000 and you're going to pay 50,000 if the business performs. It is not linked to the person whether he stays or continues. Yeah? So that's very important distinction. We need to be very, very, very conscious about this.
What is consideration? Initial consideration, there is a term that the promoter should stay for 2 years.
That's the whole issue. So the moment you say that if it is 2 years, only then this contingent consideration is going to be paid, then you...
contingent consideration, it is a consideration, initial consideration. Still it is a part of the term.
So then it is a separate this thing. The moment you link it to the continuation of employment, so you don't record a liability as a business. When you do the acquisition accounting, assets, liability, so you don't record this as a liability at that time.
That's right.
You will record it like a payroll. Whenever you pay it, it will be a payroll, like an assessment of any liability.
There is no payroll there, but only initially, initial consideration says you have to work for 2 years and no payment is there.
Right. So if there is no payment link, so what happens if he what happens if he leaves? Then what happens?
There could be some onerous, some clauses will be there. You will have to pay so much and all that.
Right. So then that's different. You'll have to evaluate very carefully. All I'm saying, we'll have to be very careful because we see this very common that it's linked to employee. You need to continue 3 years. One, you said I've paid you consideration. One, I'm saying I'm going to pay you additional. Why am I going to pay you additional? Do I believe it is the business valuation because of which I'm going to pay, or I'm going to pay you to incentivize you to continue? That's the thin line we need to be very clear about. Am I going to pay you like a bonus or a joining bonus, which is just getting deferred over a 2-year period? Okay, so that's very important. Is it salary or is it business payments?
So is remuneration like a continuous payment, ongoing payment, and contingent consideration like a one-time?
So the different, so the contingent consideration you record as a liability as a part of the business acquisition, and the difference, when you pay out, you debit, and difference goes to P&L. But here, The moment you say it's remuneration, you will record only when the probability of comes in. So you don't record on day one. As a business combination accounting, you will do a separate accounting for that. You will say that I will assess if this liability over a period of time, if it crystallizes, then I will record a liability. Because the moment you record a contingent consideration as a part of business acquisition, your goodwill number changes, right? The moment you add a liability, the goodwill goes up. Hence, we need to be very conscious about this. Yeah. Sure.
I'm not able to understand the logic. Like, if it is not reasonable compared to other employees, then it has to be treated as remuneration and.
Yeah. So this is just an indicator for you to evaluate. Why are you paying him more? If there is a justifiable reason, you're paying him more, then that's fine because he has a separate set of expertise and something. But given that if you're getting same level of people at the same, you're getting the same, knowledge center, same set of people with the same designations, why would you pay him more? What is that exceptional that you want? Is it linked to business? Because if it is linked to business, then you will basically want, so why are you paying him more? Because you want him to continue. And that could be the incentive for him. You may say that, look, if you leave, I will not pay you. So the guidance says, these are indicators, please deep dive to understand why you're paying him more. Is that like an incentive for him to pay more while you're distinguishing between others? There could be valid reasons. But what is essential is, we need to probe that to say, why is it linked to certain other payments that you're giving him more? Like a bonus. You say, I'll give you bonuses, but I will structure it like this.
It should be other way around actually. That's what the
way you look at it is whether the payment, this particular payment, is it normal for an employee to get or is he getting for a special reason? Right? Which is there. So not reasonable compared to other employee. When you say, so overall, what we are just trying to say is that if this payment is something over and above what we are getting, is it like a reasonable remuneration which any employee will get? Then it will basically be a remuneration. If it is not reasonable, which is really compared to, he's getting really some X, 3X or 2X, which is really there, which normally I will not really receive, then probably it is a contingent consideration which is linked to a business.
So are you paying him? Yeah.
Which is really there.
Are you paying him for the business valuation or are you paying him for something else? That's the whole issue. Right?
I can pay him less and then the differential amount mutually agreed, I can just shift to consideration.
Sorry, I can pay him?
Less.
Hmm.
The differential in the reasonable and the less can be added to the consideration.
No, so again,
Is it a reasonable?
no. So you have to basically assess what you're paying him. Is it reasonable versus the other employees? Now you're saying you're going to pay him less. That could be a variety of reasons why you want to pay him less. See, again, why will he take less if he's going to be equal between others? I mean, practical situation.
Because he's getting the upfront payment form of consideration.
But then that would be getting from others also, right? So point is that everybody else is also getting that consideration upfront. When you're discriminating and you're paying him less, practical situation, why will you do that? Why will he pay, why will he take less? Again, so some of these things is what we need to be probing to say what is happening here. Is it really? I agree. So it could be. So if we are able to link it to the business valuation, saying the business worth is so much and I'm deferring payments over a period, I'm going to pay you as a part of business valuation. And whether you leave or you don't leave, you will still get it. That is the business value that you're attributing and paying the shareholder. But the moment you say that if you will lose this, if you drop, if you terminate, if you lose out, then this is nothing but performance incentive.
Actually, Rajiv, I think his and Rajesh's question is the original fair valuing of consideration might require you to allocate some amount of that to remuneration.
Absolutely.
If you have paid people in advance and said now for 2 years you work,
Yeah.
and we won't pay you or we'll pay you less, that means of the original 20
I agree.
million,
So if you've paid him extra, you said, look, I'm paying you today for you to continue employment,
goes to remuneration.
then that will be, but the question that says, what happens if he leaves? Does he lose that? If he has to forfeit that, then obviously it's remuneration. Because you're linking it to employment. The moment you link to employment,
Already got it in the beginning.
that's okay,
of
but I agree. So what happens if he leaves? Because then you would have ensured that, so if you're not going to get anything, then it is contingent consideration. But the moment you say that, if you leave, you lose this. And it is nothing but performance incentives for incentive to continue in business.